Okay, welcome back everyone. Thank you for joining us in our options education webinar series. Today we're going to be talking about how to trade options, a beginner's guide. This webinar is really for those of you that are in the beginning stages of learning how to trade options. Options trading is something that does take a bit of time to get used to. There's quite a bit of a learning curve when it comes to options. So today what I really want to spend the time talking about is basic concepts to help those of you that are learning about options to better understand why you should use these products for your portfolio. What are some of those benefits? We're going to talk through what are the basic strategies you can utilize options for generating income and as well as for speculation. We'll go over each one. I'm going to try to keep this webinar fairly high level. I don't want to get very technical. I don't want to get into too many details. I want to spend most of our time just understanding the benefits of options, understand them from a conceptual perspective, as opposed to doing a lot of deeper dives. Because once you understand the strategies themselves, you can always go ahead and take that deeper dive. But today I want to keep things on a high level, talk you through the strategies, talk you through the rationale of these strategies, what are some best practices, and then most importantly, what we want to do is show you the tools that are available to you at Firstrade that help facilitate trading of these strategies that we're going to explain to you here today. My name is Tony Zhang. I am the Chief Strategist at Options Play, which is a tool that you guys have access to free of charge as a Firstrade customer. So today I'll walk you through about 15 to 20 minutes of slides talking through concepts and basic strategies. And then we'll spend the second half of our webinar showing you the tool and showing you how to actually implement the two strategies that we're going to go over here today. What we'll do is we'll go over a few different things, but I want to remind everyone that at Firstrade here, you have $0 commissions on stocks and ETFs, as well as options and mutual funds. This is really going to facilitate, for those of you that are starting out, being able to trade small where commissions is not eating away most of your trade. So especially if you're a beginner, you want to start small with just one or two contracts at a time. Firstrade really facilitates that with zero commissions across the board. Really, really great thing for beginners, because a lot of times as beginners, when you only trade one or two contracts, sometimes the commissions eats away into such a large percent of your trade. Sometimes it doesn't even make sense to place that trade. You don't have that problem at Firstrade. And Firstrade was rated Kiplinger's best online broker for ETF and bond investors. So for those of you that trade those products, definitely take a look at this platform. So today I'm going to talk about basic strategy concepts. We'll cover two strategies that as a beginner you're going to want to utilize. A cover call, which is an income generating strategy, and then buying calls and puts, which is for speculation. Those are the two strategies we'll go over. Like I said, this webinar is more so for those of you that are learning and starting out with options. But for those of you that have experience trading or maybe have traded options before, I think you'll learn quite a bit as well, because when we talk about high level, I tend to talk about the benefits and the concepts, which a lot of times if you didn't go through that learning process, you might learn something new as well. Once we cover these two basic strategies, I'll talk about best practices and kind of where to start, because that's usually the challenge that beginners tend to have, is you learn about the strategy themselves and then you log onto your platform, you don't know where to start. That's the tool that we provide here, is not only the education, but the tools so that you know exactly where to start. I will get a little technical trying to talk about the Greeks. This is a term that everyone needs to be aware of from a high level, just so you understand how the options are priced. However, keep in mind that we're going to keep the math here to a minimum, because the platform itself actually does a lot of the calculations for you. And then what we'll do is we'll end with some trading tips, just so you guys have a few different things to keep in mind when you are starting out. This is really designed to help prevent some of the mistakes that beginners tend to make. We want to make sure that you understand best practices and tips. And then lastly, the second half of our webinar, I actually want to spend most of our time using the tool that you guys have access to, so that you can jump from just the educational piece to actually more practical trading right on the tools that you have access to here at Firstrade. I'm going to start with talking about two basic strategies. These are the two strategies that you're first approved for when you apply for an options account. So first, you're going to be approved for selling covered calls. Second level you'll be approved for is buying calls and puts. So those are the two strategies that we'll cover here today. This first one is an income generating strategy. So for those of you that are looking for income, similar to buying a stock for its dividend, you can generate income by selling covered calls on the stocks in your portfolio. This is one of my favorite strategies because it doesn't apply any additional risk to your portfolio to get into a covered call. You're actually reducing risk, which is not something that can be said for any other option strategy. So selling a covered call is where you're selling a call option against a stock that you have in your portfolio. And the great part here is that you already have stocks in your portfolio that you can utilize today to generate some income. So as long as you have at least 100 shares of any stock in your account, and this includes ETFs as well, you can sell a covered call for income. Now, the best way to think about a covered call is think about the stocks that you own in your account. If you were to create a limit order to sell your stock at a higher price, what happens? You will basically wait until the stock rises in value, and once it hits that limit order, you will be able to sell your stock at that price. However, if the stock doesn't rise, then you effectively have no result, meaning you don't have anything to really show for the fact that you've submitted a limit order to sell your stock at a higher price. So you can think of selling a covered call as entering an order to sell your stock at a higher price, but actually getting paid to place that order. And if the stock doesn't rise, you actually keep the income from the call that you've sold, and you can do it again. So that's really the goal of selling a covered call, is to potentially sell your stock at a higher price, but for entering that order, getting paid to do so is, from a conceptual perspective, probably the best way to think about what selling a covered call actually means. So this allows you to take the existing stocks in your account, generate some income off of that, and in the worst case scenario, your stock gets sold at a higher price and you got paid to enter that order. That's the risk that you have when you sell covered calls, is that you will sell the stock at a predetermined price. So that is the first strategy that you should be aware of when you're entering into options. I highly recommend that's the first strategy you trade if you've never traded options before. And the second strategy that you want to look at is if you're looking to speculate. So this is for those of you that trade stocks, whether you think a stock's going to go higher, so you buy the stock, or if you think a stock's going to go lower, so you short the stock. These are option strategies to do similar type strategies. And the main difference between trading options versus trading stocks is the fact that with option strategies, many times, such as when buying a call or a put, is that you can take that directional view, either a bullish or bearish view on a stock or ETF, but you can do it with limited risk. What do I mean by that? If you buy a $100 stock and because you think it's going to go higher, your risk is $100 per share, because if that stock goes to zero, you will lose all $100. Conversely, if you buy a call option on that $100 stock for $5, then no matter what happens, even if the stock goes all the way to zero, the most amount of money you can lose is the $5 you've paid for that call option. So that's really the goal here, is to provide you with the same directional exposure as being long or short the stock, with limited risk, so that if you're wrong on your analysis and the stock doesn't go in the favor that you're expecting to, that you're able to do so with limited risk. And those are the two key areas of option strategies that we're going to explore here today. So just to reiterate, selling a covered call is taking your existing stock position, at least 100 shares of, meaning each option contract is always going to be for 100 shares. So if you have some shares that are not 100 shares, if you have some stocks that's not 100 shares, this is not a strategy you can trade. But any position that you have at least 100 shares of, you can sell a covered call against that. You can sell a call option for income, and what the resulting trade here is a covered call. What that means is, again, it's like placing a limit order to sell your stock at a higher price, but actually getting paid to place that limit order. If it doesn't go up and actually hit that limit price, you keep what you owned and you are able to continue to do so. So next, I want to look at the speculation outlook. So if you have a bullish view on a stock or ETF, what can you do? And I think the best way to look at call options, which is the strategy that you would trade if you're bullish on a stock or ETF, is to compare it to buying a stock, because that's the closest comparison that we can make. And that's the one strategy that most of you are probably familiar with. So both buying a call option and buying a stock is where you anticipate gains in the underlying stock or ETF. That's the rationale behind both of these two strategies. As far as risk goes, buying a call option, your risk is limited to the premium that you've paid for the call option. So we talked about if you buy a $5 call option, no matter what happens to that stock, you will only lose no more than $5. On the stock trading side, your risk is limited to the price that you paid for the shares. So if you have a $100 stock and you paid $100 for it, then your risk is $100. So substantially more risk to buy the stock versus buying a call option. And that's really one of the reasons why people consider taking a look at a call option instead of outright buying the stock. Your potential reward on both trades is unlimited upside reward, meaning if you buy a $100 stock and it keeps going higher and higher and higher, you will continuously make money off of that trade. As long as it continues to go higher, you will make more money. So your reward is unlimited to the upside on both sides. Your break-even price, meaning where does this strategy actually start creating profits? That's really where on the call option, it's a little different than buying the stock. If you buy a $100 stock, your break-even price is what you paid for it, $100. Meaning even if it goes to $100 and 1 penny, you're going to be in the profit. Versus on the call option, that's not the same case. If you buy a $100 call option and you have to pay $5 for it, your break-even price is that $100 plus the $5. So the stock doesn't need to go to $100 and 1 penny. It has to go to $105 before the strategy is profitable. So that's the key difference between buying a stock and buying a call option, is that you have to overcome an initial cost before your strategy is actually going to be profitable. And lastly, the biggest difference between buying a call option and a stock is the fact that you have time, a time to consider when you're buying an option. So when you're buying an option, you have to consider an expiration date, and you will only maintain this upside exposure until the expiration date. Once that expiration date is up, you will no longer have any additional exposure to any upside in the stock. Versus if you bought the stock, you can hang on to the stock for as long as you want, and as long as you own those shares, you will participate in any upside on that stock. So those are the key differences to trading call options versus stock. Now on the short side, what you would do is you would buy a put option. And this compares to shorting a stock. And shorting a stock is something that we may understand conceptually, but from a practical perspective, it's not always very practical. And that's really why buying a put option sometimes is a much better trade to make if you're bearish on the trade than outright shorting the stock. So same thing, buying a put and shorting the stock. Both are for if you anticipate a decline in the underlying stock or ETF. So if you have a $100 stock, you think it's going to go lower down to 90 or 80 or 70, that's when you would consider buying a put option or shorting the stock. When you buy a put option, just like the call option, your risk is limited to what you paid for that put option. So if you paid $5 for the put option, your risk is limited to that $5. When you short a stock, unfortunately, that is when your risk is unlimited. So if you short a $100 stock and the stock goes to $500, you will lose $400 a share, even though you've only borrowed it at $100. And your risk is absolutely unlimited to the upside. And that's really one of the downsides of shorting a stock, is that you do have that truly unlimited risk. And I would never, ever recommend anyone to take a trade that has truly unlimited risk, because you never know what can happen. Your analysis can always be wrong. No matter how good of a trader you are, there's always going to be the opportunity that you're wrong on your analysis. You never want to expose yourself to unlimited risk if you have the ability to have a better alternative, such as buying a put option. Both trades will give you unlimited upside reward. This is really one of the key areas of buying a put option versus a short stock, is that you still maintain that upside exposure if you're correct on your analysis. Your break-even price on the short stock is the price that you borrow the shares at. So as long as if you borrow the shares at $100 and the stock goes down to $99.99, you will be profitable. The break-even price on a put option is the same as a call option, where it's the strike price minus the premium. So if you buy a $100 put and you paid $5 for it, now your break-even price is going to be $95. So the stock does have to move a certain amount first by the premium before you're able to take a profit on this particular trade. So this is really, again, very similar to buying the call option in terms of buying a put. is that the stock needs to move a certain amount before the strategy is profitable. And just like the call option, you only maintain exposure until the expiration date. And that expiration date is something you get to choose. However, once that expiration date comes up, you will no longer have exposure. When it comes to shorting the stock, you will have exposure until you return those shares, the shares that you've borrowed. But that's really where short stock, depending on what you're borrowing, can have various costs because it's not free to borrow a stock. You have to pay margin interest on that. So there is a limit to how long you may be able to short a stock for, but those are some of the things why short stock usually is not a strategy that's very recommended, because you always have the option of buying a put option instead. So now that we've talked a little bit about these strategies and just from a concept perspective, I want to do a quick scoot over to options play. This is the tool that you guys have access to here at Firstrade. This is the tool that's designed to help you better understand where to start with respect to buying a call or a put or selling a cover call. And what I just want to do is very quickly just show you a couple of examples just to solidify what we just talked about here. So I have an example here, Facebook. Facebook is a fairly weak stock that's really taken a beating since it missed earnings last quarter, or 2 quarters ago rather. And this stock is certainly continuing to trend lower. So what I have an example here is shorting the stock. So shorting the stock here gives you downside exposure versus buying a put option. I just want to put some numbers behind it. Facebook's trading at 137. To short that stock, you'd have to post a fair amount of margin to do so, but you can buy a put option for just $695. So a very small percentage of the underlying shares, about 4% or so, 4 to 5% of the underlying shares, to purchase a put option, which gives you the same downside exposure as shorting a stock, but your risk is limited to only $695 per contract. So this is just a quick comparison of shorting the stock to buying a put. Conversely, I'm going to look at another stock, Merck & Company. This is a pharmaceutical company doing quite well, especially during this market sell-off. As you can see throughout October, instead of selling off, this stock has actually accelerated in growth. These are the types of strength that we typically look for when we're buying a stock. So here, Merck is trading at $78. As you can see, buying 100 shares of that stock will cost you $7,800. Buying a call option only costs you $236. So maintaining the same upside exposure as owning the stock, but risking only $236 for every 100 shares versus risking $7,800 per 100 shares. So that's just a quick comparison of buying the stock to buying a call and shorting the stock to buying a put. And then for income strategies, for those of you that are looking to generate income, such as selling covered calls, I'm going to jump over to what's a good stock for this. Let's say Johnson & Johnson. Let's say you own Johnson & Johnson. Maybe you've held on to the stock for a while. It's trading at 146 right now. Let's say you're happy getting rid of this stock at a higher price. Let's say 152.5. What can you do is you can sell a January 4th 152.5 cover call, which basically is the same as placing a limit order saying that if the stock reaches 152.5, I'll sell this stock at a profit. But to place that limit order, you don't get paid to do so. And if the stock doesn't get up to 152.5, you don't get paid anything. So selling a cover call here will actually pay you $51 to enter that order. So that if on January 4th, 2019, the stock is at 152.5 or higher, you will be able to sell your stock at a profit at 152.5, and you're going to collect your $51. If the stock doesn't go to 152.5, then you just keep your $51 and you can place another order to sell at 152.5 or whatever price that you're willing to let go of your shares of. And you can do this over and over again, and that's why we call this an income generating strategy. So that's just a very quick sneak preview into what we offer here at Options Play that's designed to help you view these strategies, compare these strategies, and better understand them. And the reason we created Options Play was because if you've ever pulled up an options chain before, this is traditionally how options are quoted. You have a page that tells you expiration date and all the different strike prices that you can buy a call or a put or sell a call or a put at. This screen is usually quite daunting, in my opinion, for a lot of beginners. Because I think the question that most people have is, where do I start? If I'm looking to buy a call, what expiration dates should I look for? What strike price should I look for? If you're selling a cover call, same question, what expiration, what strike price? And even if you are an experienced trader, about half of you answer that you have traded options before and you know exactly where to start. The questions that you have to ask yourself, like if the stock goes higher by 5%, how much money do I make? Or if the stock goes down by 5%, how much money do I lose? The answers to those questions are not easily figured out by using an option chain. That's why we created Options Play, so that you can utilize our P&L simulator that will actually show you exactly how much profit you would expect from buying the stock. And if the stock went up to 152.5, how much money exactly would you make on the stock versus how much money would you make on the call option? This is all designed to make your life a lot easier, so that not only do you have starting points, you actually have access to tools to help you make those decisions confidently. So we're going to jump back to the slides, and I'll come back to the Options Play tool in a second. I want to talk you guys through these best practices for where to start. So for those of you either that are brand new and learning, or for those of you that have experience trading, the biggest question that I usually get with most of these strategies is, what expiration date and what strike price should I start with? And that's a really good question, because that's really where all of your analysis starts. So when it comes to cover calls, it's best to choose relatively shorter dated option strategies or shorter dated option expirations. Usually anywhere from 3 to 7 weeks out is where you spend most of your time selling cover calls. I'm not going to get into the research and the numbers behind that right now, because we have separate webinars just on these topics alone, talking about why we pick these types of expirations. This is more so on a more high-level webinar. And when it comes to selling cover calls, you always want to sell out of the money calls. So these are basically strike prices that are above the current stock price. So in that Johnson & Johnson example, and the stock is at 147, you want to sell a call option that's above the strike price, above the current price, because you want to be able to sell your stock at a profit. That's the goal of selling a cover call. When you're buying calls and puts, it's a little different. You usually want to start off a little longer dated. Usually anywhere from 1 to 3 months out is where you want to start looking at when you're buying a call or a put. This is really because of something that we'll talk about in the next slide. But basically, when you're buying a call option, you have time premium working against you. And to help mitigate that, you usually want to go a little further out in time. 1 to 3 months in terms of expiration is usually a good starting point. And when you're buying calls and puts, instead of looking at out of the money calls and puts, you usually want to start at the money. So meaning strike prices that are near the current stock price is a good starting point if you're buying calls or puts. So that's just a very quick best practices for expiration date and strike price starting points for these two strategies. Next, in order to really understand these strategies and understand how they perform, that's really where we want to look at the Greeks. And a lot of people say, why do we have to understand the Greeks? You know, there's a lot of math. I don't like doing any math. And the answer is, you don't have to do the math. We actually do the math for you. But it's really important to understand why the math is important. And the whole goal of understanding Greeks and calculating Greeks is so that you can calculate profit and loss. Because if you buy a call option and you think the stock's going to go up 10%, how do you know how much profit you actually get from that? That's the reason why we use the Greeks. Because the Greeks tell us, if the stock goes up 10%, how much money do I make? So I'm going to talk about this from a very high level, just so you guys understand it. Just keep in mind that you don't have to actually do any of this math, because Options Play does that math for you. So when you're trading options, there are a lot of different Greeks, but there's only two that I think is really important for beginners to understand. The first one is delta. That tells you the change in the option price with respect to the stock price. So when we ask ourselves, if the stock goes up 10%, how much money do I make? That's what delta is able to calculate for you. So if you have a call option that has a delta of 0.5, that's telling you that the option will increase by 50 cents for every dollar that the stock increases by. So basically half the amount that the stock moves, the option will move that amount. So delta is what tells you that. Again, that's just so that you understand what delta is. You don't have to know how to calculate it. We actually do that math for you. The second thing that's very important to understand when it comes to trading options is theta. So theta is the change in the option price with respect to time, because the value of an option, because there's an expiration date on it, will actually change in value as time goes on. And theta tells you how much that change is going to be. So theta is always going to be expressed as a term that tells you exactly how much the option will lose in value for each day that goes on. Option prices will always erode with time. So time is always working against you when you're buying options because you have negative theta. You're losing money every time you're holding onto a trade, a long option. And if you're selling an option, such as in the cover call, you have positive theta. So that's actually working in your favor. So it's really important to understand this concept of when you're buying options, the option value is eroding and it's working against you. When you're selling options, that erosion is actually working in your favor. And that's really why we usually want to start users off by selling options, because you have this time value working in your favor. And only when you're ready to start speculating, that's when you have to buy options in order to do so. That's when you have this time value working against you. So that's why these two Greeks are very important to understand from a conceptual perspective. And again, you don't have to calculate it because we do all those for you. So lastly, I just want to cover some trading tips. This is really to help provide some tips, if you will, so that you hopefully don't make some of the mistakes that we may have made as traders ourselves. So when it comes to selling options, when you're selling cover calls, the goal is to actually hold these calls that you've sold until expiration. You want to hold that cover call until expiration because you can sell a call for, let's say, 50 cents. And if the call option expires worthless, you keep that 50 cents. That's the income you're generating from this strategy. So the goal is to hold it all the way to expiration. And what you want to do is simply repeat that cycle over and over again. That is the income stream that you'll be able to produce by selling cover calls. And lastly, it's really important to have an exit plan. I'm not going to get into the specifics of that exit plan because we do have a separate webinar just on cover calls where we do talk about the different scenarios, but it's really important to have planned out what are the different scenarios and how you're going to handle each one. When it comes to buying options, when you have a bullish or bearish view on an underlying stock, the goal there is actually don't hold that trade until expiration. Because of that time value that we talked about where the option value erodes against you the longer you hold on to that trade, you only want to hang on to a call or a put option as long as you are continuously bullish or bearish on that stock. The second you're no longer bearish or bullish because it's hit your target price, or maybe it's just worked against you, you don't want to continue holding on to that call option or put option. You want to exit that trade prior to expiration. And second of all, this is a strategy that you should only utilize when you're expecting a large move. If you think the stock's going to move 1 or 2% or just mildly move in one direction or another, buying a call or a put option is not the right strategy to trade. You should only do this when you're expecting a fairly large move. Maybe there's a news announcement coming out. Maybe it's broken above a major support or resistance level and you think the stock's going to really rally or break down. That's usually when you want to buy a call or a put. And lastly, just like any other trade really, have an exit plan. And that really comes down to understanding what is likely going to happen if the stock goes in your favor, how much profit do you expect, and also at the same time understanding if the stock doesn't go in your favor, how much money do you lose. Planning for that ahead of time really allows you to have an exit plan so that when the stock hits your target price or hits your profit target, you simply get out and take your profits. And if it goes against you, you are aware of how to cut your losses and move on from that trade. So those are the tips that I really recommend for those of you that are beginning or even experienced traders to follow when you're trading either one of these two strategies. So lastly, let's move over to options play. I want to show you some real examples of this and show you how you can take an idea, quickly plug it into options play, and take a look at some option strategies around that. So let's go back to Facebook. And I'm only using these stocks. This is by no means a solicitation to trade these stocks or a recommendation to trade these securities. I'm pulling up these stocks because these are fairly big names that most of you are probably familiar with, maybe follow, perhaps even trading yourselves. So I want to produce names that you guys are following and show you some ideas as to how to actually implement them. So the platform itself is Options Play. You can launch it using the Trading tab under Options. If you click on the Options Trading tab, you'll see a button here on the right that says Options Wizard. If you click on that, that's going to launch Options Play. This is designed to make your options trading experience as easy and as intuitive as possible because, like I said, when you're using pages like this, I don't find that very intuitive in terms of understanding where to start. More importantly, even if you know where to start, how do you actually decide whether the strategy gives you the right payoff that you're looking for? So that's why we created Options Play, to make your life a little easier in terms of helping you find that starting point and then giving you the calculations such as the delta and theta calculation that we're talking about to show you exactly how these strategies perform. So here's Facebook. It's trading at 137. Like I said, this is clearly a bearish stock and a bearish trend at 137. So I do think that to the downside, it can easily move down to at least 127, which was the low that was just at a few days ago, 126.5. So what are the options that you can do? So as you can see here on the bottom of your screen, there's always two buttons. One says I'm bullish, which will always present to you 3 bullish strategies, or I'm bearish and present to you 3 bearish strategies. We're just going to focus on these 2 strategies today because these are the stock strategy that you might be familiar with trading yourself today and the simple option strategy of buying a put. We're going to leave this more complex strategy for another day. That's for those of you that are a bit more experienced. This is a more complex strategy that will allow you to trade multi-legs. But we're going to focus our attention on just shorting the stock and buying a put as our first example. So like we said before, shorting a stock requires a substantial amount of margin. Buying a put option costs you $695. Now let's actually see how these strategies perform. So the reason that you would short a stock or buy a put is because you think Facebook's going to move lower. I think conservatively, you can probably target 127, and that's really where we're going to use our P&L simulator. This is how Options Play can calculate all the Greeks for you so that you don't have to do any calculations yourself. So let's say we think the stock's going to go down to 127. How much money will you actually profit from shorting the stock? You make an 8.24% return if you had shorted the stock versus an 87% return on the put option if the stock goes down to 127. And I would say 127 is a fairly conservative target because this is for January 18th, 2019, which is roughly 45 days from now. This stock was just at 127 last week, and we have all the way till January to be able to potentially turn a profit on this particular trade. Conversely, you can also say that I think it's going to go to 127 by the end of the year. So I can adjust this price to say, what happens if it hits 127 by the end of this year? As you can see now, my profit actually increases to 89% if I had bought this put option. So you can create all different types of scenarios and see for yourself exactly how these strategies perform, which is something that you're not able to do when you just look at an option chain. If I said that this stock's going to go up or down 10% in the next 2 weeks, how do you know how much money you make off of these strategies? As a trader myself, I used to have to do back of the envelope calculations to estimate this, but that's not a really good strategy in the long run, and it's not very accurate, and you're prone to mistakes. Options Play does all of the calculations for you so you know exactly how strategies perform next to each other and be able to see whether or not these strategies will be profitable for you. So what happens if the stock goes down to 122? How much money do you make? Again, back of the envelope calculations may give you a close estimate, but what you really want to know is exactly how much money you make or lose using our P&L simulator. And once you've decided on a trade that you want to make, you can hit the trade button. And what we do is we pre-fill a ticket for you so that you can see exactly what you're buying and selling, what your risk and reward is. We even have a strategy checklist just to make sure you understand the risk of what you're trading. So are you trading with the trend of the stock? Are you trading with the trend of the market? The Options Play score, which is the risk to reward metric, giving you an idea as far as how much risk versus reward you're taking. We also check to see if there's earnings between now and expiration. And lastly, spread and liquidity. We look at how liquid something is before you place a trade. So if this Facebook put is pretty liquid, everything looks good here. If you're ready to place that trade, all you have to do is hit the preview order button, and we actually pre-fill your order ticket for you at Firstrade. This is designed to make this a completely seamless integration for those of you who are exploring options using Options Play and then want to trade that through your Firstrade account. Let's jump back over to Options Play here. I want to walk you through a few different examples here. I don't have a lot of time left, but I want to try to walk you through as many examples as possible. I'm going to go back to that Merck's example. So again, we're going back to that pharmaceutical example. Very strong stock, outperforming the market clearly right now. A little pullback on Tuesday. So let's say we want to go long this company because we feel that this is a company that will perform well over the next few weeks. What can you do? Traditionally, you'd be able to buy that stock, but that costs you $7,800. Conversely, you can buy a call option for only $236. They give you similar upside exposure, but limited risk. And this is really one of the key areas of limited risk that we want to explore. I didn't look at the downside on Facebook, which I probably should have, but let's take a look at Merck's trading at $78. Where do you think the stock can go? I think at the very minimum, it can go back to the $80.25, the 52-week high, which is the 52-week high from Tuesday. So if we went up to at least $81, how much money do you make? If you bought the stock, you make a 3.5% return. If you bought the call option, a 48% return. And that's till January 18th. What happens if this stock makes a nice move over the next few weeks? What if by Christmas, this stock is trading at $81, which is where it was just on Tuesday? You make a 63% return by buying the call option versus only a 3.5% return on the stock. So far what we've done is we've only explored the upside, right? Saying exactly how much money you make or how much more money you make from buying a call option. But let's also look at the downside. I do see that, this stock has rallied quite a bit over the last week. What happens if this stock drops down to $74? Or even worse, what happens if it drops down to $71? How much risk do you have? And that's really where options really shine. Because if I had bought this stock here at $78 and paid $7,800 for 100 shares, and the stock drops, which for those of you that have been trading over the last few weeks or last few months, I'm sure you're aware of, there have been pretty crazy days where the markets are down 600, 800 points. And this could happen in a matter of just a few hours, that this stock could go back down to $71. What happens if it does? If you had bought the stock, you're risking $721, a substantial amount of capital. Not only does it take you more money to trade the stock, you're actually risking a lot of money if the stock starts to correct. Versus if you bought the call option, your loss here is only $231. So your only risk is limited to what you've paid for that call option. And that's really the key to looking at call options instead of buying that stock. Because if you're correct, you're going to be able to make a nice return on your investment for substantially less capital to get started. But more importantly, and I think this is actually the most important piece, is that if you're wrong on the trade and the stock does plummet, that your risk is actually limited to what you've paid. So here, if the stock, even if it goes down to 73.5, which I think is a fairly conservative downside risk, you're risking double the amount on buying the stock than you are on buying the call option. And that's really one of the key areas of why you should consider taking a look at a call option instead of outright buying the stock. And once you're ready to place that trade, you can hit the trade button, check the strategy checklist to see what you're doing. The only thing here is you're trading against the trend of the market because the market is starting to trend a little lower. So as long as you're aware of that risk and you're okay taking that risk, you can hit the preview order button and that will actually send your order off for execution. You can preview that order and send it right off into your Firstrade account without having to place anything other than just clicking on that trade button. So let's just go back real quick, and maybe I'll just very quickly go through that Facebook example to show you the risk of it. And I think Facebook is probably a good example of this because this is a stock that has been beaten up substantially, but it is a stock that produces a lot of revenue. This is certainly not similar to some of the other tech names where they don't turn a profit and they're actually losing money. Facebook makes a lot of money. So there is always the risk that this market turns back around, maybe technology shares recovers a little, and if the stock goes back up to even 155, 156, which is where it was in late October, if it goes up to 155, if you had shorted the stock, you would lose $1,600, almost $1,700. Versus if you bought the put option, you lose only $695, a fraction of what you would lose if you had shorted the stock. Another reason why I would never recommend shorting the stock, that if you were bearish on a stock, you should always consider taking a look at a put option. And then lastly, let's go over to Johnson & Johnson again. I want to walk you guys through a cover call. I want to show you how easy it is to find a cover call, because on the income tab here in options play, we have a button here at the bottom that's called income settings. We'll cover this in our cover call webinar for those of you that want to learn more about the strategy, but you can set your own settings for covered calls. You can set the time frame, how far in expirations you like to go out to sell your covered calls. You can even set your risk tolerance. Are you conservative when it comes to cover calls, or aggressive, or somewhere in between? Once you create these settings, for any stock that you type in, you will actually be able to very quickly see what your ideal starting point for selling covered calls are. So if you own Apple stock, you want to be able to sell your stock at a profit, but be able to generate some income to do so by selling a covered call. This tells you exactly where to start. At December 28th, 187.5 cover call. It breaks down the trade for you so you know exactly how much income that you're receiving, what the yield on that income actually is, and it breaks it down for you in plain English. Compare that with using an option chain. If you wanted to sell a cover call on Apple using the option chain, it would take quite a bit of time for you to first figure out what expiration to start with. Then you're scrolling through pages and pages of screens like this to figure out where is your ideal starting point. Then you have to calculate yields manually before you enter that trade. This does it all for you in the click of a button. So if I'm looking at Microsoft, I know exactly which cover call to sell, December 28th, 115 cover call. That's driven off of my personalized settings that I create in income settings, and it breaks down the trade for me. So I know that I'm getting a 5.85% annualized yield on a stock that only pays you a 1.7% dividend. If you own Microsoft, your yield is 1.7%. By adding cover calls to it, you can add an additional $585. So if you own Microsoft, would you be okay with selling the stock if it rallies up to 115 by December 28th? If you are okay with it, sure, you can place this order. And if you don't, you will get paid $40 to place this order. So that's exactly why these strategies are the most popular strategies. Cover calls are by far the most popular strategies because they allow you to monetize your existing assets that you hold in your account. The stocks that you hold in your account, some of them generate some dividends, some of them don't. Facebook stock, if you own it, pays no dividends. So adding a cover call to Facebook stock that you might own allows you to sell that stock at a higher price if it does rally and get paid for it by placing that order. Instead of placing a limit order, you can sell a cover call. It achieves similar type risk profile because if the stock rallies, you're able to sell your stock at a profit, but you're going to get paid to place that order. So that's why we think that you should consider taking a look at cover calls as an alternative, or not necessarily an alternative, but as a strategy to add to your portfolio. Even if you have no interest in speculating on direction and you just simply have a stock portfolio, cover calls allows you to add additional yield to that portfolio by potentially selling your stock at a profit. So with that, that covers what I wanted to go over with you guys today. I hope you guys really find this useful in helping you better understand these option concepts, as well as inspire you to take a look at tools that make this process as easy, as intuitive as possible for you. So you can click on the trade button if you have a bullish or bearish view on any stock and see your starting points, provide you with the tools to calculate your expected return so you know exactly what to expect on each strategy. And for those of you that are looking to generate some additional yield on your portfolio, clicking on that income tab, looking at cover calls as an alternative to outright owning that stock. So with that, I want to thank everyone for taking the time out on this market holiday to listen to us talk about these strategies. And at this point, what I'll do is I'll open this up for Q&A. If you have any questions, please type them into the chat window or the Q&A window, and I will answer as many questions as I have time for. It looks like I have a couple of questions here already. Nathan saying, unless it pays a dividend, why wouldn't you always buy a call option as opposed to actually buying the stock? Well, there's a lot of reasons that you would buy the stock as opposed to a call option. If you're a long-term investor, there's a reason that you might want to own that stock. A call option is only a short-term speculative strategy. So if you're a long-term investor or a value investor, that's typically why you buy the stock. But if you're speculating on short-term moves based on technicals or something like that, a call option may many times provide you with a better risk-to-reward ratio than outright buying the stock. I have another question here. How do you set up an indicator below the chart? Do I need to consider the volatility before I place a trade? I would say for most of the strategies that we're talking about here, volatility is not something that you have to be deeply concerned about. It certainly is something for those of you that are a little bit more advanced. But in terms of setting an indicator, you click on this the expand button, and you can enter any of these indicators that we have here. We have popular indicators, but a ton of different indicators that you can add to your screen right here on Options Play. How does one sell a call or put option after purchasing? Does it work like a stock? Similar to a stock, basically if you own a stock, you sell it to exit it, you do the same thing for a call or a put. The only difference is on a call or a put, you have to specify whether it's an opening order or a closing order. So anytime you're closing a option trade, you have to make sure it's a closing order. For that, I highly recommend you to call your Firstrade broker. They'll be able to help walk you through that trade. So if you're a first-time options trader and you're trying to close out a trade, please call your broker and have them walk you through that first trade so that you set it up correctly. Angelo is asking, where can I see the value of theta and delta in Firstrade? Great question. So on the trade button, if you want to learn about the deltas of each trade, you can click on the expand button for any strategy. And here at the bottom, we have explained strategy in Greeks. And we really try to explain it to you in English terms as opposed to Greek terms. And that's really why we created our platform this way. However, I will say that I don't know that everyone needs to look at delta and theta. It's something that you really only need to calculate P&L. That's the reason that you even bother calculating delta and theta. But our tool does it all for you. You don't need to do any of the calculations yourself. Our P&L simulator calculates delta and theta and just spits out the result for you, which is really what you're looking for. So you can see it, but we hide it for a reason because you don't need it. We'll do all the calculations for you. If there are no more questions, again, I just want to thank everyone for taking the time out on this market holiday to listen to this webinar. Like I said, when it comes to options, especially since so many of you are brand new, just keep in mind that this is something that takes time to learn. This is not something that you learn overnight, but that is why we created this program. Number one, to teach you some of the basic concepts so that you understand what are basic strategies, best practices, and help avoid some of the mistakes that a lot of people will make. But more importantly, we wanted to show you the tools that are available to you at Firstrade that really make this learning process as easy as possible. You know, when you're using the option chains, this is really overwhelming. A lot of beginners tend to get scared off when they're staring at that type of screen and saying, I don't know where to start, or I don't understand all the numbers. And that's okay. We really want to make that learning process as intuitive as possible with Options Play. So I highly recommend, if you're starting out with options, take a look at Options Play first, because it's going to help make a lot of the concepts that we teach you here easier to understand. There seems to be a question here. What kind of requirement do you need to trade vertical calls? Great question. I think the question is, what do you need to trade this third strategy? You just have to apply for your options agreement, and the option principal at Firstrade will determine what level of sophistication you have to trade these strategies. So the first level is always going to be cover calls, selling cover calls. That's the first level that you'll approve for. Second level is buying calls and puts. And the third level would be trading spreads like verticals. So you would be able to call your Firstrade broker and be able to ask them that question on how to apply for a higher level if you do want to trade those vertical spreads. Thank you so much. I hope everyone is enjoying this day off in the markets, and happy trading to everyone tomorrow. And I will see you guys in a couple of weeks on the next webinar. Thank you so much for taking the time out this afternoon, and I hope you guys all have a great evening.